When you start a dividend portfolio and you're in years 1, 2, or even 3, you don't really see very much crazy growth. You see your dividends and your portfolio slowly increase, but it's really not very dramatic. But there is a reason that so many investors love and follow a dividend growth strategy. And that is because of the power of growth over time. In today's video, I wanted to walk through an example using real numbers to show you the power of this strategy. A dividend portfolio can grow over time through a combination of dividend reinvestment and capital appreciation. The whole idea of dividend investing is that you start off with a portfolio of dividend-paying stocks and/or ETFs, and then when that pays you a dividend, you reinvest it. This means that you then start to accumulate and own more shares in subsequent years, and as a result of this, you get larger dividend payments. And this keeps happening and it grows exponentially. It compounds over time. Okay, so let's actually walk through an example here. So on this table here, you can see on the left-hand side, we have the number of years. So we're going to look at an example from years 1 to year 10, and I've also included year 11 at the bottom here, just to kind of show you where this portfolio has potential to go in the future. Because the thing with dividend growth investing is that, and any investing actually in general, is that time is really the key factor. The longer you have, the better compounding you get, and you see that exponential growth. So I didn't want to plot like 1 to years 50, but you can sort of start to see where this could go. Then we have stock investment, which is the amount of money into the stock or the accumulation of stocks of the portfolio. Dividends paid, how much this portfolio paid in dividends every single year. And then the total, which is the combination of the two previous columns and the dividend growth. So this is meant to be dividend growth rate. I just didn't have enough space, but I'll get onto this in a bit. But essentially what this is showing you that this portfolio, this investor is following a dividend growth strategy. In this portfolio, there is going to be a stock or a collection of stocks that are able to consistently increase their dividends every single year. So these are like the dividend aristocrats, the dividend kings. Think Coca-Cola, think McDonald's, maybe Legal & General here in the UK. Those sort of companies that are able to grow their dividends year on year on year. I'm going to reveal the first line and then we'll start to work through this. So just some assumptions about this before we begin. So we are assuming someone has £5,000 that they are going to put into this portfolio. That might be one stock, a collection of different stocks. It doesn't really matter on the ins and outs because this is just an example to show you the numbers and to make the point of how this can grow over time. In this portfolio, they're going to do a lump sum investment of £5,000 and then they're not going to add any more money into the portfolio, but they will be reinvesting the dividends. Now, the dividend yield in this portfolio, whether that's from one stock or an average of the different stocks in the portfolio, is going to be 2%. But we're going to assume a dividend growth rate of 3% every single year. So the dividends are going to grow and grow and grow. You're going to get the reinvesting and you're going to get also an 8% annual return on average every single year. Of course, this is just an example and we'll get to some exceptions and why this may not be exactly how it happens in the real world in a bit. But anyway, what you can see here is that the investor puts £5,000 into the portfolio. They are going to get paid a 2% dividend yield. So in their first year, over the first 12 months, they are going to get £100 in dividends paid from this portfolio. So at the end of the first year, they're going to get £5,100 in total in their portfolio. They put £5,000 in, they got paid £100 in dividends, they are left with £5,100. And like I said, that was assuming a 2% dividend yield. Moving into year 2 now. What has happened since? Well, this £5,100 has also seen capital appreciation, stock price growth of 8%, like I said. So 8% on top of this figure here gives you £5,508. And what we've had in this as well is the dividend growth. So like I was saying, every single year, we're assuming a 3% dividend growth rate. So 3% of this 2 gives you 2.06. So in year 2, you get paid slightly more. You get £113.46 in dividends. So at the end of year 2, the total portfolio is worth £5,621.46. Moving into year 3, again, you've got that capital appreciation, the 8% return, and that gives you £6,071.18. Your dividend growth has increased again, and you've got £128.71 paid out across those 12 months in year 3, leaving you with a total portfolio value of £6,199.89. Now, I'm not going to move through every single one of these years and read them out, but let's just reveal all of the other years and we can start to work through what's actually happening here. So you can see that the dividend growth rate is increasing by 3% every single year. So if we jump now to year 4, at the end of year 4, you have £6,841.85. Dividends paid £145.97. At the end of year 5, your portfolio is now worth £7,554.72 with £165.52 in dividends. If we jump ahead a few years, in year 8, you start the year off with £9,968.26p. This time around, you're getting £244.22 in dividends, leaving you at the end of the year with £10,212.48. So by year 8, you have over doubled your original investment, which is really not that bad considering that you haven't put any more money into this. You put £5,000 in year 1, and by the end of year 8, you've already got over double that amount of money. And then with the reinvesting of the dividends and the 8% return that we're assuming, you start the year in year 9 off with £11,029.48. This year, you get £279.05 in dividends, which you can see is a lot higher than you started year 1 with, ending the year with £11,308.53. And then you move into your final year, you start off with £12,213.21. You're now at £317.54 of dividends paid over the 12 months in your 10th year, compared to the £100 that you saw in year 1. So that's gone up by over 3 times, which is quite impressive. And if you think about this with bigger numbers, this is just going to be even crazier. Ending the 10th year with £12,530.75. So year 1, you put 5,000 in, you got 100 in dividends. Year 10, you're sitting at 12,530 and £317 in dividends. So that is a pretty insane growth, I think. And that is just from that £5,000, reinvesting those dividends, pumping money back in, accumulating more and more shares, and picking stocks that have this dividend growth. Now, I've included year 11 here as well. I won't read it out, but what I wanted to point out is how the difference in these dividends that you're getting and the total value is increasing by larger increments as the years go on. You can't really see it that much when you look at the early years, but it's when you sort of get, year 7, year 15, year 20, you get a long period of time that you really start seeing this. But you can see even so, the dividends increase between years 1 and 2, £13. Nothing crazy. But if you then take 2 and 3, 3 and 4, and you look at it over a long period of time, they're increasing by a little bit more, and it gets more and more crazy as time goes on. The same with the total value of the portfolio as well. Now, we did make some assumptions here. We said that we were expecting an 8% return on average for these 10 years. Now, of course, the stock market is a little bit more volatile than a steady 8% return, but this is on average. Some years you may get a 20% return, other years you may get -2, but on average 8%. Realistically, if you were to pick a 10-year time period in the market, you probably wouldn't necessarily get 8% on average. You might get 5%, you might get 9%. It's a little bit more volatile out there in the real world, but it's a good example nevertheless. We are assuming that this is investing in a single stock or a selection of different stocks that give a dividend yield of 2%. 2% is quite reasonable, it's quite a low yield, but it may not be realistic for everyone. Other people may have higher, they may have lower, but also we're assuming that this portfolio is able to grow the dividends by 3% every single year. Some companies may be able to do that, but you've also got to factor in that a company may cut their dividends, they may stop them altogether, they may just not be able to increase them by 3%, maybe it's lower. That will all have an impact. And of course, the last thing to point out is inflation. We all hear this word, we all know it, we all love it, but inflation does have a massive impact on the total amount that a portfolio is actually worth. So for example, we could have a look here and say in 10 years, this portfolio is going to be worth £12,530, but actually in 10 years time, that £12,500 is not worth £12,500 as we know it today. So another thing to factor in. I also just wanted to include this shown a bit more graphically for those visual people out there. What you can see here is these grey bars is showing you the total portfolio value. And then the green bars are showing you the dividends paid. Now, of course, these green bars look really tiny just because of the scale on this portfolio and the way that I've presented it. But I promise you they are increasing over time, with year 11 being a lot bigger than year 1 and 2. And more importantly, this total portfolio value, you can see that it's increasing in this sort of curve. It's seeing exponential growth because of the compound interest, because of the reinvesting their dividends, accumulating more shares. This is all really, really powerful stuff. If this was just a linear growth, you would see a straight line, but you can see that it's starting to show this curve. And what happens over time is it keeps going up and up and up, and it gets more and more steep. And like I was saying, in the early years of a portfolio, you're not really going to see it that much. Even up to year 10, it's not going to be crazy. But there's a certain point, maybe after year 10, maybe year 12, whatever it may be, that it starts to really take off. And that's when you really start to see that, your portfolio value is going really crazy. And the dividends that you're making, they're sort of able to sustain your lifestyle. So that's when it gets really, really nuts. I hope that was interesting, and I hope that it was good to actually see an example with real numbers and to see the dividends growing over time and how the dividend growth rate can affect everything as well. Of course, this is super simplified. So please note that. Things will be different to this in the real world, and this was just a really simple example, just using some real numbers to literally give you guys an example. So I hope you've enjoyed it. If you want to become a Patreon member and get access to my Discord, then use the link in the description below. If nothing else, thank you for watching again. Thank you for supporting the channel as always, and I'll see you again shortly in another video.